What net profit percentage actually makes you a professional Forex trader? I want to give you a number today. But before I do, I need you to honestly examine the number you're currently carrying in your head. Because almost every trader walking into this conversation has a figure, spoken or unspoken, that they've decided represents making it in Forex. For most people, it's somewhere between 20% and 50% per month. Some of you are thinking higher than that. And I understand why. The content you've been consuming, the screenshots, the verified results, the traders showing off their monthly statements, has been quietly, persistently calibrating your expectations upward, not through lies necessarily, through selective visibility, through the human tendency to share the extraordinary and stay silent about the ordinary. Here is the number that will actually shock you. The benchmark that separates amateur traders from genuinely professional ones, the return that the world's most respected hedge funds, the most consistent institutional traders, the most celebrated names in the industry use as a measure of real, sustainable excellence, 3 to 5% per month. Not 30%, not 50%, not triple-digit annual returns. 3 to 5%. Per month, consistently, over years. I can already feel the resistance, that can't be right, then what's the point? And I want to sit inside that resistance with you for a moment, because the gap between what you expected and what I just said, that gap is not a disappointment. It is the most important piece of financial self-knowledge you might encounter this year. Let's talk about why. Here's what the Forex content ecosystem has done to your perception of normal. It has filled your feed with outliers and presented them as the standard. It has shown you the 1% of weeks where someone caught a perfect trend and made 40% in 3 days, and quietly omitted the 47 weeks of grinding, modest, unremarkable work that surrounded it. It has built a mental environment in which anything less than extraordinary looks like failure. And that environment is destroying traders, not because the extraordinary results don't exist. They do, occasionally, for brief windows, under specific conditions, with specific risk profiles that most professional traders would consider reckless, but because the relentless exposure to those outliers has created a deeply distorted benchmark that makes real professional performance look like underachievement. Let me put this in real terms. Warren Buffett, arguably the most successful long-term investor in human history, has averaged approximately 20% per year over his career. Not per month, per year. The best-performing hedge funds in the world, firms managing billions of dollars with rooms full of PhDs and proprietary algorithms and decades of institutional experience, target 15 to 25% annually. The ones hitting 30+% are considered extraordinary. George Soros, in his legendary career, averaged around 30% annually. You, trading a $5,000 account from your spare bedroom with a 2-year-old strategy you backtested for 3 months, have decided that 30% per month is the minimum that makes the enterprise worthwhile. Do you see the problem? The industry has convinced retail traders that professional performance starts where institutional performance ends, and that fundamental misalignment between expectation and reality is the invisible engine behind most of the behavioral pathology we see in retail Forex: the over-leveraging, the revenge trading, the inability to sit on a modest winner, the constant strategy switching in search of the real edge that produces the numbers that YouTube thumbnails promised. Here's what nobody tells you. The psychological work of this video is not to lower your ambition, it is to recalibrate your timeline. It is to show you that the professional path leads somewhere extraordinary, just more slowly and more surely than the content you've been consuming would have you believe. Realization 1. You've been measuring the wrong thing entirely. Let me be honest with you about something that took most traders years to understand. Percentage return per month is not the primary metric of professional trading performance. Read that again because it cuts against almost everything the retail trading world talks about. The primary metric is consistency of positive performance over time, combined with controlled maximum drawdown. Not how high your winning months go, how low your losing months go, and how reliably you produce positive results across a wide enough sample that the output cannot be explained by luck. The old behavior. You have a month where you return 18%. You feel extraordinary. You screenshot it, you share it, you use it as evidence that the strategy works. Then, the following month, you lose 22%. Net result? You are behind where you started. But the 18% felt like proof, so you continue chasing the same high-variance approach that produced it, not understanding that the approach that gave you the 18% is the same approach that gave you the 22% drawdown. The new behavior, you design your approach not around maximum return potential, but around maximum return consistency. You accept that a method producing 4% per month with a maximum drawdown of 6% is infinitely more valuable and more indicative of genuine skill than a method producing 18% one month and negative 22% the next. You begin measuring yourself not by your best month, but by your worst month. Because your worst month is the truest measure of your risk management, which is the truest measure of your professionalism. The psychology here is a concept called peak-end rule, the human tendency to evaluate experiences based on their peak intensity and their final moments, rather than their average. Your brain does not naturally calculate the average of 12 months. It remembers the 18% month and uses that as the representative data point. This is how intelligent people make deeply irrational assessments of their own trading performance. Think about Lena. She had been trading for 2.5 years. In that time, she'd had 4 months she called exceptional, returns above 15%. She referenced those months constantly in conversations about her trading. They felt like proof of what was possible. They felt like what she was really capable of. On the good days. What she rarely mentioned, what she barely tracked, was that her average across all 30 months was negative 1.2% per month. The exceptional months were separated by brutal drawdowns and slow, grinding recovery periods. The exceptional months were not evidence of skill, they were evidence of variance. When a mentor finally sat her down and walked through the actual compound math, the real journey of her account across all 30 months, not just the highlights, something shifted in her face. Not defeat, recognition. The kind of recognition that feels uncomfortable at first and liberating later. She said, "I've been using my best days to lie to myself about my average days." That sentence. Remember it. Because it might be the most honest thing any trader can say. The investor's chief problem and his worst enemy is likely to be himself. Benjamin Graham. Here is the thought I want sitting with you. If someone calculated your true average monthly return across every month you've traded, including the months you'd rather forget, what would that number be? And is that the number you're using to assess whether you're making progress? Realization 2. What 3 to 5% per month actually builds, the math nobody shows you. Let me show you something now. Let me show you why 3 to 5% per month is not the consolation prize, it is the destination. Because when you run the compound math on consistent, modest, professional-grade returns, really run it with a calculator and honest numbers, the result is not underwhelming, it is staggering. A trader starting with $10,000 returning a conservative 3% per month consistently. Year 1, $10,000 becomes approximately $42,576. Year 2, $42,576 becomes approximately $181,273. Year 3, $181,273 becomes approximately $771,552. 3% per month, starting with $10,000, 3 years. Over $770,000. Now, here is what makes that number real rather than theoretical. A trader producing 3% per month consistently has a risk profile that allows for scale. They can raise capital, they can attract investors, they can take on a prop firm account or a fund allocation, because consistent, controlled performance is the currency that opens institutional doors. The trader swinging for 30% per month with a 40% drawdown history cannot scale. No institution will give them capital. No serious investor will allocate to them. They are permanently capped at whatever they personally own, because the volatility of their performance makes them uninvestable. This is the irony that the industry never explains. The modest, consistent, boring trader becomes exponentially wealthy over time and eventually has access to other people's capital to multiply it further. The exciting, volatile, impressive trader plateaus permanently at a ceiling defined by their own account balance and their own inability to compound without self-destruction. The old behavior. Aim for the highest possible monthly return, maximize position size in the conviction trades, accept high variance as the price of high performance, celebrate the exceptional months, and rationalize the drawdown months as anomalies. The new behavior, design the system around maximum consistency. Accept lower peak returns as the deliberate cost of lower variance. Understand that the compounding engine only works if you stay in the game, and staying in the game means never having a drawdown large enough to require an extraordinary recovery before you return to growth. The psychology here is a concept called loss aversion asymmetry. A 50% drawdown requires a 100% gain to recover. A 20% drawdown requires a 25% gain to recover. A 10% drawdown requires an 11% gain to recover. The math of losses is not symmetrical with the math of gains, which means every additional percent of drawdown you allow is exponentially more expensive than the one before it, and the professional trader has internalized this in a way the amateur never quite has. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Often attributed to Albert Einstein. Here is the thought I want your subconscious mind working on. What if the biggest thing standing between you and real wealth from trading is not the size of your winners, but the consistency of your survival? Drop a comment right now if this reframe just changed something for you. Just type compound, because the traders who understand this principle really understand it in their bones, not just intellectually, trade differently from the moment they do. Realization 3. The professional doesn't think in percentages, they think in processes. This is where it changes. Here's something that will sound almost impossibly simple when I say it, and yet represents a transformation that takes most traders years to actually embody. The professional trader does not think about return percentages while trading. They don't sit at the terminal calculating how much they need to make this month to hit their target. They don't adjust position sizes to accelerate toward a percentage goal. They don't look at their account balance mid-session and think, I need X% more this week. They think about one thing: am I executing my process correctly? The return percentage is not an input, it is an output. It is the natural consequence of consistent, correct execution, something that reveals itself over time, not something that gets chased in real time. The old behavior. I'm up 1.8% this month. If I can get one more good trade, I can hit 3%, but I need it to be a big one. This line of thinking, which sounds harmless, is the entry point to some of the most destructive decisions a trader makes. Position size inflated, setup criteria relaxed, hold time extended past the plan, all in service of a percentage target that has nothing to do with what the market is actually offering. The new behavior? Is this a valid setup by my criteria? Yes, then I will enter with my standard risk and execute my standard management. Whatever this month's return turns out to be, it will be the honest output of correct execution. I don't negotiate with that. The psychology here is the distinction between what psychologists call process goals and outcome goals. Research consistently shows that in complex probabilistic environments, sports, medicine, trading, investing, performers who focus on process goals outperform those who focus on outcome goals. Not because outcomes don't matter, because focusing on outcomes while you're inside the process degrades the process. Think about a surgeon who, in the middle of an operation, starts thinking about their success rate statistics. That mental shift from the immediate task to the abstract outcome metric introduces exactly the kind of distraction that increases error. The best surgeons are not thinking about their success rate at the table. They are thinking about the next precise action required. The best traders work the same way. Let me tell you about Marcus. Marcus spent his first 3 years of trading almost entirely focused on monthly return targets. He kept a spreadsheet with what he needed each week to hit his monthly goal, and he checked it constantly. He adjusted his trading based on it. When he was behind pace, he increased exposure. When he was ahead, he sometimes got cautious, not out of discipline, but because he was afraid to give back the cushion he'd built. Both of those behaviors, increasing size when behind and getting cautious when ahead, were driven by the same mistake, managing to a number instead of managing to a process. He eventually worked with a coach who gave him one instruction that felt almost insulting in its simplicity. For the next 90 days, close the account summary tab. You are not allowed to know your percentage return. You are only allowed to evaluate whether each trade followed the plan. Marcus did it. It was one of the hardest things he'd done in trading, not looking, not knowing, trusting the process with no real-time performance feedback. At the end of 90 days, his coach revealed the results. It was his best quarter since he started. Not his best because he'd swung harder, his best because he'd stopped managing to a target and started executing a process. And a well-designed process, executed cleanly with no interference from performance anxiety, had produced the results that performance anxiety had been preventing. It is not the man who has too little who is poor, but the man who hankers after more. Seneca. Here is the thought I want living in the back of your mind. Are your decisions at the terminal being made by your process or by the gap between where your account is and where you think it should be? Realization 4. The real standard is not monthly return, it is months of positive performance. Here's the reframe that separates the professionals from everyone else. Imagine two traders. Trader A made 26% over 6 months. Trader B made 18% over the same 6 months. By the obvious metric, Trader A performed better. But here is the complete picture. Trader A's monthly breakdown, plus 18%, minus 12%, plus 24%, minus 15%, plus 19%, minus 8%, net 26%. Trader B's monthly breakdown, plus 4%, plus 2%, plus 3%, plus 4%, plus 3%, plus 2%, net 18%. Now, which trader would you rather be? Which trader would you rather invest capital in? Trader A experienced 3 negative months, 3 months of drawdown to recover from, 3 months where the compounding engine ran in reverse, 3 months of emotional challenge, potential rule breaking, and the psychological cost of recovery. Trader B had 0 negative months, consistent, uninterrupted growth, no recovery required. The compounding engine ran forward every single month. Trader A's results are more impressive on a headline level. Trader B's results are more valuable in every meaningful sense, in terms of actual wealth building, scalability, investability, and psychological sustainability. The professional standard is not monthly return percentage. It is the ratio of positive months to total months, combined with the average of those positive months and the depth of the negative ones. A trader with 10 positive months, 2 flat months, and no negative months across a 12-month period, with average positive months of 4%, is a more proven, more valuable, more scalable trader than one with 7 positive months averaging 9% and 5 negative months averaging -7%. The math is simple. The psychological acceptance of that math is profound. Because accepting it means accepting that a month where you made 2.3% and followed your plan perfectly is a better month than one where you made 11% through elevated risk that happened to work out. It means redefining excellence downward in peak and upward in floor. It means caring more about your worst month than your best one. The old behavior: celebrate the 11% months. Regret the 2% months. Spend energy trying to find the conditions that produce the 11% and replicate them. The new behavior: celebrate any positive month that was produced through disciplined execution. Regret only the months where the process was violated, regardless of whether that violation happened to produce a win. Spend energy systematically improving the floor of performance, not chasing the ceiling. An investment in knowledge pays the best interest. Benjamin Franklin. And here is the thought I want to leave in your subconscious. What if your goal for next month was not a return target, but a process score? What if you measured success by how many trades followed your plan exactly, regardless of outcome? Realization 5. Why small, consistent returns require a larger identity than big, volatile ones. Let me say something that might be the most counterintuitive thing in this entire video. It is psychologically harder to make 4% every month than it is to make 20% some months. Not technically harder, psychologically harder. Making 4% consistently requires you to take profits that feel too small, to walk away from setups that feel almost right, to sit on your hands for days when the market isn't giving you what your plan requires, to watch other people apparently making more and resist the pull to do what they're doing, to accept that this month's modest return is enough when every instinct you have is calibrated by a culture that says it isn't. That is a harder psychological task than swinging for 20%, because swinging for 20% feels bold. It feels like you're giving it everything. It feels congruent with the narrative of the ambitious, driven person you want to be. It feels like the kind of effort that deserves a big result. And accepting 4%, claiming it consciously, deliberately as your professional standard, requires dismantling a story about yourself that goes much deeper than trading strategy. It requires becoming a person who values precision over excitement, process over drama, sustainability over spectacle. It requires what I can only describe as a kind of professional maturity, a shift in identity that is not less ambitious than the person chasing 20% per month, but differently ambitious, ambitiously patient, ambitiously disciplined, ambitiously unremarkable in the service of remarkable long-term outcomes. If you've felt the pull of this tension, the part of you that knows the modest, consistent approach is right, but still finds it deflating to embrace, you're not alone. Every serious trader I've ever spoken to has sat at exactly this crossroads. The ones who chose the modest, consistent path never regretted it. The ones who kept chasing the spectacular are still chasing it. The desire to perform all the time is usually a barrier to performing over time. Robert Olstein. Here is the thought I want sitting with you. Who would you need to become, not as a trader, but as a person, to genuinely find satisfaction in a 3% monthly return consistently delivered year after year? The year Priya stopped trying to be impressive. I want to tell you about Priya. Priya had been trading for 4 years when she finally had the conversation with herself that changed everything. Not a conversation with a mentor, not a revelation from a book, a conversation, honest, private, a little painful, with herself. She was a physician, methodical, rigorous, deeply trained in probabilistic thinking. She was, by any reasonable measure, better equipped intellectually for trading than most people who attempt it. And for 4 years, she had failed to grow her account in any meaningful way. Not catastrophically, she hadn't blown anything up, but she was essentially flat. 4 years of activity, of learning, of genuine intellectual engagement with the markets, and her account was within 8% of where it started. She knew her strategy worked. She'd backtested it meticulously. She'd tracked it through 2 years of demo and 6 months of small live trading. The edge was real. The win rate on paper supported consistent monthly growth, but something was wrong with the live execution that she couldn't quite name. The conversation she finally had with herself began with one question: what am I actually trying to prove? And the answer, when it came, surprised her. She was trying to prove that she belonged, that she, a person who had never thought of herself as financially sophisticated, who had spent a decade earning credentials in a field that had nothing to do with markets, actually had the right to sit at this table. And to her, belonging meant performing impressively. It meant monthly returns that looked like proof. It meant screenshots that justified the hours. It meant something she could show to herself, if not to anyone else, that said, "See, this is real. I'm actually doing this." 4% per month didn't feel like proof. It felt like surviving. And she hadn't spent 4 years and thousands of hours surviving. She'd done it to arrive. The day she understood that, really understood it, not just as a concept, but as the living engine of her underperformance, she sat with it for a long time. And then she made one decision. She would trade to be consistent, not to be impressive, not to prove anything. Consistent. Just that word. Every session, the only question would be, was this consistent with the process? Not, was this impressive? Not, is this enough? Consistent. The first month of that reframe, 3.1%, her quietest month in 2 years. She felt a strange combination of peace and anticlimax. The second month, 4.7%, better, still quiet, still no drama. The third month, 2.8%. She had 2 stopped-out trades and 1 winner. She checked her journal, all 3 were correctly executed. The result was within normal variance. She wrote, "Good month. Process score, excellent." She didn't write "good month" because 2.8% excited her. She wrote it because for the first time in 4 years, a month that looked modest felt like success because she had finally defined success correctly. By month 8 of her reframe, her account had grown more than it had in the entire preceding 3 years. Nothing changed in her strategy. Everything changed in her relationship to what the strategy was supposed to deliver. She told me later, "I stopped trying to win and started trying to be right, and being right consistently turned out to produce all the winning I needed." That shift from performance to precision, from impressive to consistent, from proving something to building something, is the shift this entire video has been trying to describe. And it is available to you. Not next year, not after you find a better strategy, right now, in how you define what a good month looks like. Identity evolution. Let me be direct with you now. Everything we've discussed today ultimately comes down to one question of identity. Who are you trying to be as a trader? Not what returns you're trying to make, not what strategy you're trying to master. Who are you trying to be? Because the trader who chases 30% per month is, underneath the trading activity, a person trying to feel extraordinary, trying to feel like an exception, trying to produce results that match an internal image of what success is supposed to look like. And the trader who builds toward 3 to 5% per month consistently, who genuinely embraces that standard, who finds satisfaction in it, who measures themselves by process quality rather than headline returns, that trader is someone different. They are a person who has replaced the need to feel impressive with the commitment to be excellent. And excellence, in trading as in most things, is quiet. It is repetitive. It is often invisible to people looking for dramatic proof. But it compounds. The identity shift required here is not about lowering your standards. It is about elevating them in the dimensions that actually matter: precision, consistency, emotional regulation, process integrity, while releasing them in the dimension that has been destroying you, the need for your monthly return to feel like validation. Imagine becoming a trader who genuinely does not care what their best month looked like, who cares deeply and specifically about what their worst month looked like, who holds that as the truest measure of their development. Imagine becoming a person who can sit at the terminal after a 2.6% month and feel the quiet satisfaction of a craftsperson who did their work correctly. Imagine having the patience, not as a performance, not as gritted teeth, but as a genuinely internalized orientation toward time, to let 3 years of consistent execution reveal what it will reveal about your account. That person is not less ambitious than the one chasing monthly fireworks. They are immeasurably more dangerous. Because they are building something that cannot be stopped by a single bad month, that cannot be undone by variance, that cannot be derailed by the comparison game, that compounds quietly, patiently, inevitably, toward an outcome that the headline-chasing trader will never see because they are not willing to build it the way it actually gets built. This is the identity. This is the work. And it starts in the next session with the question, not how much can I make today, but can I execute my process perfectly today? Just that. Closing. Let me bring everything back to the number. 3 to 5% per month. I want you to hear it differently now than you did at the beginning of this video. Not as a ceiling, not as a disappointment, not as the evidence that trading isn't worth pursuing. Hear it as a standard, a real one, the kind of standard that separates people who are genuinely building something from people who are indefinitely chasing something. Hear it as the benchmark that the world's most respected traders use to measure excellence, the benchmark that hedge fund managers fight to achieve, the benchmark that applied to compound math over years produces outcomes that most people would consider impossible from just trading. And hear it as the answer to the question you've probably been asking yourself for longer than you'd like to admit. Am I good enough at this? If you are consistently producing 3 to 5% per month with controlled drawdowns and disciplined execution, yes, you are good enough. More than good enough. You are in the company of professionals. If you are not there yet, that's not evidence that you can't be. It's evidence that the work continues. And knowing the real target rather than the inflated fictional one the content ecosystem gave you means the work now has a genuine direction. You are closer than you think. Not to some spectacular screenshot-worthy month, but to something more valuable. To the identity of a trader who builds patiently, who measures correctly, who treats the process as the product, and who trusts that the returns follow when the foundation is right. That foundation is what this channel exists to help you build. Not with shortcuts, not with strategies that promise to change everything. With honest conversations about what professional trading actually looks like from the inside, in the months that don't make highlight reels, in the decision-making that happens before the trade and after it, in the identity that holds the whole thing together. Be patient with the timeline, be relentless about the process, and measure yourself, always, by the standard that actually means something. The secret of getting ahead is getting started. The secret of getting started is breaking your complex, overwhelming tasks into small, manageable tasks, and then starting on the first one. Mark Twain. Call to action. If this video recalibrated something for you, if the number landed differently than you expected, if the math showed you something about compound consistency that you hadn't fully seen, if Priya's story sounded like a version of your own, then I need you to do one thing. Subscribe right now, before you open another chart, before you check another pair, before the moment passes and this video becomes just another thing you watched. Because what we do on this channel is rare. We don't tell you what the market is doing this week. We don't give you the next strategy. We don't sell the dream. We sit with you in the real work, the psychological work, the identity work, the work of becoming the kind of trader who builds something lasting rather than something impressive. If that's the work you're here for, this is where you belong. Subscribe. Turn on notifications, and if this video answered a question you've been asking for a while, share it with the trader in your life who keeps chasing the big months, with the person who measures themselves by their best trade instead of their average process, with whoever needs to hear that 3% done right is worth infinitely more than 30% done recklessly. They need this conversation. You were ready for it today.